Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is about preparing a statement of cash flows, and what we'll do in this video is go through the steps that you need to take in order to prepare a cash flow statement. There are 9 steps that you need to look at. The first one is you take the profit before interest and tax from the income statement. Can be called various things. It's often called the profit before finance costs. So what we're starting off with is a figure from the income statement, and we're going to work back from that figure to another figure that's closer to cash flows. Every step we take will bring us closer to cash flows. So step number 2 is to add back the total depreciation on all of the non-current assets and any losses on the sales of assets, of non-current assets. They may be given to you, the losses on sales of non-current assets, and the depreciation may be given to you in the question, or you may have to work it out. You may have to look at the movements in non-current assets from the start of the year to the end of the year using the balance sheet information and any extra information you're given to work out what the depreciation is and what the losses or profits on sales of non-current assets are. You will need to understand accounting for depreciation and accounting for non-current assets. So if you're having difficulty with this section, you should go back and you should revise the chapter on assets and look at some of the videos on assets, how the accounting is done for the acquisition of new assets and the disposal of assets. It's only through that you'll be able to tackle all of the various kind of curveballs that occur in these questions. The third one is subtract profit on sale of assets. Well, if we've had a profit on sale of assets, that will be included in the profit before interest and tax, and we need to get it out because that is an accrual item. We will be worrying later on in the cash flow statement about the amount of actual cash we've received for the asset, but this is the cash flow statement. We don't want these kind of accrual items in it, so we add that. We subtract a profit on the sale of assets to bring us closer to a cash flow figure. We show inflows and outflows from current assets and liabilities. This is generally receivables, payables, and inventory. An increase in receivables or inventory is an outflow. If we're investing more money in inventory or we're allowing receivables to owe us more money, then we don't have that money, and that is a negative as far as cash flow is concerned. An increase in payables is an inflow because if payables are increasing, we haven't actually paid the cash to them, and that's a good thing from our cash point of view. And the reverse is true as well. A decrease in receivables or inventory is a positive. It's an inflow, and you add that, and a decrease in a payables is an outflow, and you subtract that. So just think through the logic of what happens when people owe us more money or we have more inventory. and you'll get the right answer there for whether you add or subtract, whether it's an inflow or an outflow of cash. Step 5, for interest, we need to work out what was the interest that was paid, and you're not generally given that information directly. You need to work it out from 3 pieces of information: the amount of interest we owed at the start of the year, the amount of interest we owed at the end of the year, and the interest charge that you see in the income statement. So the logic we use is to say, well, if we owe 10 of interest at the start of the year and we charge 30 during the year, then if we didn't owe any at the end, then we must have paid 40. But if we do owe, like say 20 at the end, then we've only paid 20. So you use that kind of logic to work out what is the interest paid, and be sure you understand the difference between something interest paid and the interest charged in the income statement. Tax paid is exactly the same. Look at the tax position at the start of the year, how much tax was due, look at the tax charged for the whole year, and then look at the tax due at the end of the year. And with those 3 pieces of information, you will be able to work out the tax paid during the year. When you've done all of that, step 7, you can calculate the cash inflow or outflow from operations. So this is the first heading that you've got completed at this stage. Step 8 is to work out any additions and disposals of non-current assets. You may have had to do this already in order to work out the depreciation charge or the profits and losses on the disposals of non-current assets. You may need to do some workings for this, so that will vary from question to question. What you're looking for in step 8 here is you're looking for the amount of cash that we paid out for new non-current assets and the amount of cash that we receive for disposal of assets. So you look at the individual questions for how you actually do that in different circumstances. And then step 9, we look at the cash inflow or outflow from financing. This is going to be things like increase in share capital. You'll get that from the equity section of the balance sheet, or loans. They're both going to be an inflow, and equity dividends paid is going to be an outflow of cash. And you're now in a position to add up the cash flow statement. The cash flow statement should add up to be the same thing as the change in cash in the balance sheet. So last year's cash compared to this year's cash, what is the change? And the cash flow statement should explain that. So that's how you do a cash flow statement in 9 steps. We're now going to move on to an example where we will go through these 9 steps for a particular company called Rochester PLC. Go through preparing a cash flow statement for this company, Rochester PLC. This is an example from chapter 13 of the book. What you're generally given in order to be able to prepare a cash flow statement is 2 balance sheets for the company. So we can see here's the balance sheet, the assets, the non-current assets, the current assets for 2 years, 20x6, 20x5. Now remember that the latest year will be in the left column over here, and the last year's results will be in the rightmost column over here. So don't get confused about that. And we've got all the general things that we expect in the balance sheet here, and we look at these one at a time. We're also given the income statement down here. We're given profit before finance costs, interest, which is finance costs, profit before taxation, tax, and profit for the financial year. We're also given some extra information here about depreciation. There were no disposals and of land or buildings, but there was a disposal of plant, and we'll have to look at that later on. A profit of 2,000 was made on this disposal, and dividends of 55,000 were paid during the year. So what we're going to do now is we're going to go through the 9 steps that I just talked about in relation to preparing the solution for this question, the cash flow statement. So this is the solution here, and down here we'll look at the 9 steps. So the first one is to take profit before interest and tax. So we're going to get out of the income statement over here, profit before finance costs. And that will go up here, so that will be our first line of our cash flow statement. The second thing we're going to do is to take depreciation charges and add them back. Depreciation in this question is 112,000. This is these two amounts added together. Now in some questions you won't be given depreciation directly. You will be asked to calculate that from other information, but you'll always have to have enough information to actually reconstruct what happened to the non-current assets and work out how much depreciation actually was for the year. The next thing, so depreciation charges are our second line up here, depreciation charges 112. The next thing is the profit on disposal. Now a profit on disposal is an accrual item. It will have gone into the income statement. We can't see it here because it would have gone into the income statement further up than we have here. And it is a non-cash item. So the same way as depreciation, we need to get it out of the income statement. It's a profit, so we'll have increased the profit. So to get it out of the income statement, we need to now deduct it. So we deduct the profit on disposal. If it was a loss on disposal, we would add it. The next things that we need to worry about are the inflows and outflows from the current assets and liabilities. So we look back at the balance sheet here. We see inventory has gone from 278 to 320. That is an increase of 42. And you can think about it this way. More inventory means that we have invested more money in stock that's just sitting there. It's not generating cash for us. So that is a bad thing. More inventory is a bad thing as far as cash is concerned. So that's a minus 42. A decrease in receivables. Well, think about that as if our receivables have decreased, more people have paid off their debts to us. And that is a good thing from our cash balance point of view. So the decrease in receivables of 56, that is a plus item there in the cash flow. And then we look down at current liabilities. Our payables went up by 12. Okay, there we go. 12 increase in payables. That is a positive item for cash flow. The more we owe to our suppliers, the less money we've paid them. So that is better for our cash balances. The next thing we need to work out is interest paid. Okay, so here this one's, sometimes this is straightforward, sometimes it's not. Let's look at the balance sheet first, and we see interest is on the balance sheet. And the way to interpret this is, last year we owed 1,000 of interest at the end of the year. This year we owe 10,000 at the end of the year. We've another piece of information down here in the profit and loss account, or the income statement. We charged 18,000 of interest for the year. So that is on an accruals basis. That is like, what was the interest from the 1st of January to the 31st of December? We haven't necessarily paid all of that interest. So the way we work the calculation is we say, well, we owed 1,000 of interest at the start of the year. We clocked up 18,000 of interest during the year. So if we hadn't paid anything, we would owe 19,000 at the end of the year. But in fact, we only owe 10,000 at the end of the year. So what we must have paid is 9. And you can see that there in the cash flow statement. And, you should probably have a read through these explanations if you're finding this difficult at all. Tax paid, that's step number 6. Very similar logic to interest paid. We look in the balance sheet, we see last year we owed 114,000 of tax. This year we owe 60,000. So we think out we also see in the income statement that the tax charge for the year, not necessarily what we paid, but the tax charge for the year, the tax that attaches to this financial year, 20x6, was 75,000. So what we do is, I'll just pop up a calculator here. We take the 114 plus, that's what we owed at the start, plus the 75. That's 189. That's what we would have paid, that's what we would owe at the end of the year if we hadn't paid any tax. But we know from the balance sheet over here that we owe 60 at the end. So we mustn't have paid all that 189. So if we deduct 60 there, we get 129. That is the tax paid for the year. Okay, again, careful read through that note in the textbook if you're confused about that topic. So we've now got the whole operations section of the cash flow statement done. We're down to operating cash flow of 383. So that's just an addition of all those items up there. Okay. The next section that we've got to worry about is investment. And this section relates to any capital investments we've made, like the purchase of new assets or any disposals of assets. But here what we're looking for is the cash that came in or out from those transactions. So what did we pay for new assets? What did we receive in cash for old assets that we disposed of? Okay, so the payments to acquire non-current assets. Okay, we have to work out why the non-current assets value changed from 2005 to 2006, or 20x5 to 20x6. How do we do that? We'll look at land first. So you need to look at these non-current assets, each category. We started off with 100,000 of land. We ended up with 250 of land. We know from this note down here that there were no disposals of land, so we didn't sell any. We know that there isn't depreciation on land because there never is. We don't charge depreciation on land. So that implies that the whole change, 150, must be additions to our holding of land. Okay, so we've got 150 from land. That's that figure there. The next thing we have to look at is look at buildings next. So buildings, we started off with 50,000 of buildings. We ended up with 500,000 of buildings. We know there were no disposals of buildings during the year. So that rules that out. There was, however, some depreciation of buildings during the year, which was 10,000. So that means we must have purchased buildings for 460,000, because we started off with 50,000 of buildings. We depreciated by 10, which means the buildings would have been down to 40, and then we're ending up with 500. So we must have bought 460,000 of buildings. So that's that 460 there. And then the third thing is plant and machinery. We started off with 707 of plant and machinery. We ended up with 765. There was a disposal of plant and machinery. Plant which cost 50,000 and had a net book value of 30,000 was disposed of during the year. A profit of 2,000 was made on this disposal. Well, let's leave the disposal for a minute. What we now need to explain is how the 707 changed into 765. This can be explained by three things. Firstly, additions to our holdings of plant and machinery. Two, disposals of our holdings, and depreciation. We know that depreciation on plant and machinery is 102,000. We know that we disposed of 30,000 at net book value, and we're working in net book value here. We're not given any information about the costs. So if we start off with the 707, and we're told that the depreciation was 102 minus 102 equals 605, and we also had a plant which was disposed of, had a net book value of 30, so we subtract that as well. That gives us 575, but we can see on the balance sheet that the closing balance is 765. So if we just subtract 765, and then we'll have to reverse the answer, reverse the sign on the answer, that means that we must have bought 190,000 of buildings. Okay, and again, any confusion about that, make sure you read through that note thoroughly and explain to yourself what's going on. So we have 190 plus 460 plus 150, and they all come to 800. That is an outflow because those are payments to acquire non-current assets. The next thing we have to work out is we have to work out how much we got for the asset that we sold. So the receipts from the sales of non-current assets. Well, we sold it for, we sold a piece of plant which had a net book value. So that is cost minus accumulated depreciation. A net book value of 30,000 was disposed of during the year. A profit of 2,000 was made on this disposal. Well, we know that the profit on the disposal of a fixed asset is equal to the proceeds minus the net book value. Well, we know both the net book value and we know the profit, so we must have received 32,000 in order to explain us getting a profit of 2,000. So the receipts from the sale of non-current assets are 32,000. If you're having difficulty with these profits and losses, go back and look at the video about the disposals of non-current assets, or read the chapter about the disposals of non-current assets. That was in the assets chapter. Okay, so that's the investment section done. Now we've just got to do the financing section. We are told in the question that dividends of 50,000 were paid during the year. They go into the financing section. We look at the equity section of the balance sheet. We can see equity share capital went up from 100 to 220. That's 120 increase. That's an inflow. An issue of long-term debt. Our long-term debt went from 0 to 200. Okay, so that is an inflow as well. And our cash, our decrease in cash is then 120 when we add up all of these things here. It should come to minus 120. We go back to our balance sheets and we can see the cash went from 140 to 20. That is minus 120 as well. Okay, so that is the cash flow statement. And then the next thing is, how do we interpret that cash flow statement? You know, how can we make sense of it? Well, what we can see for this company is that it had healthy operating cash flow of 383,000. So it was generating 383,000 from its operations. However, it paid a lot of money, 800,000, to acquire new assets, which had to be financed then, partially at least, by issuing new debt and issuing new equity. But even with all that new finance coming into the company, they still their cash still declined by 120,000. So that's the bones of interpreting a cash flow statement. Okay. Okay, thank you.